get started then. Okay. So again, that's what we're learning about. Oh, left my brain over here. Can't be without my phone. Okay, we're learning about fraud, internal controls, and cash. Those are separate concepts, but they're all closely related. So that's why they're all kind of bundled together in this chapter. So we'll learn what fraud is. Obviously, fraud is a bad thing, right? Nobody likes to be the victim of fraud, but hopefully none of us will ever be the perpetrator of fraud either, because it's illegal and it's unethical. I think by almost any definition, you can agree that fraud is unethical. We'll also talk about what are the internal controls you can have in your organization to prevent fraud or theft or other misuse of assets. We will talk about petty cash. Petty cash is one tool that could be used to try to prevent theft within your organization. And it's also a way to make the purchase of small items more efficient. So we'll learn about the whole petty cash process. We'll learn about management's responsibility for maintaining the internal controls within an organization. We'll learn to do what's called a bank reconciliation. And that's basically just where you take the information that your bank has about your bank account and the information that's in your accounting records about your cash account, and you compare them to figure out how much cash you really have. So we will get to bank reconciliations this week, and we'll discuss fraud in financial statements and the Sarbanes-Oxley Act. Have I mentioned Sarbanes-Oxley? Has that come up in previous chapters? No? Okay. If you took Intro to Business, you might remember hearing about it there. But it's a law that was passed back in 2002 that has a major impact on how we do accounting today in corporations. So this is what we will be talking about. As it says here, fraud is, in this course, defined as the act of intentionally deceiving a person or organization or misrepresenting a relationship in order to secure some type of benefit. So in other words, fraud is tricking people in order to get something. And that's why it's both illegal and it's unethical. So all organizations have to be aware of fraud. An employee can commit fraud against the customers, against their employer. An entire company can commit fraud in some cases. So you need to, if you're in charge of an organization, you need to make sure your organization is not committing fraud, right? But also not being defrauded, not being tricked by employees, or maybe suppliers, or maybe creditors, or anybody else that's trying to trick your organization. In other words, don't be a scammer and don't scam other people, right? That's really what we're talking about. Now, for fraud to occur, there have to be three things that are present, and this is called the fraud triangle. There has to be an incentive. There has to be perceived opportunity, and there has to be rationalization. So let's talk about each of those, starting with incentives. If somebody is a gambling addict or a drug addict or any kind of addict, that throws off their sense of morality, and it might cause them to do things that they know are wrong, but their addiction almost forces them to do it. So you could call that a vice, right? Some sort of bad habit or addiction that a person might have that causes them to do bad things. That could be one incentive that causes somebody to commit fraud, Another thing, maybe financial pressure. Maybe they're broke, or maybe they really want to, move out of their house where they're living in their parents' basement, right? And so they feel this pressure that they need to be able to get an apartment. They don't have the money. So that financial pressure might cause them to do something they know is wrong. Or maybe they owe some money to a bookie or a loan shark or something. And if they don't pay up, they're going to get their legs broken. So they have this incentive to do something, even if it's wrong. Maybe they're pressured. Maybe their boss is telling them to do something that they know is wrong. I don't know if I've mentioned this to you, but there was a case at WorldCom, which was a company where the executives committed fraud, multi-billion-dollar fraud. And there was an accountant working at WorldCom. Her name was Betty Vincent. And she knew that what her boss was telling her to do was not GAAP compliant. And she also knew it was fraudulent because her boss was telling her to enter data into the accounting system that was not correct. It was a lie to put this information into the accounting system. It would make their company look more profitable, but it was a lie. So it was not GAAP, and because it was being done with the intent to deceive investors, it was fraud. And Betty said, no, I'm not going to do it. But her boss kept pressuring her. And she finally said, okay, but just this one time. So she did it. And guess what? Her boss expected her to do it again. And again. And again. So then it became a pattern. Like once she'd already done it one time, it was hard for her to tell her boss no. Right? And so she did it multiple times. But her conscience kept bothering her. And she eventually contacted the authorities. I think it was the FBI she contacted, but I'm not 100% sure. But she contacted some government regulator and she said, hey, this is going on at WorldCom. I think you should know about it. Well, guess what? They already knew about it. And when the company had to pay the price, eventually the executives got called into court. They were sentenced. They were, the company itself doesn't exist any longer, right? So when everything hit the fan, Betty Vincent, because she blew the whistle, she did get a lesser jail sentence than she would otherwise have gotten. But she still had to serve time. If she'd still violated the law, she'd still committed fraud. So that was a case where it was work pressure from her boss that caused her to help commit fraud. Or you might just have people who want to look successful. There's so many podcasts and documentaries and exposés about these people that they so desire to be wealthy and famous and successful, they commit fraud. And their frauds just get bigger and bigger until they get caught. To me, it's one of the most fascinating things. So I'm kind of addicted to those podcasts. That's my addiction. But it's out there. And a lot of times these people do have what's called a personality disorder. They might be narcissists. They might be sociopaths. But they do these crazy, crazy things, and they love it. It's a thrill for them to deceive people and to look like they're super successful when in reality they're scammers. So this is one part of the fraud triangle. There has to be some incentive that causes the person to want to commit fraud. Right? Because none of us wakes up and says, oh, I think I'll commit fraud today. No, there has to be a reason. Any comments, any questions so far on incentives? Okay, so there also has to be a perceived opportunity. If you want to trick somebody that you don't think you'll be able to trick them, well, then you're not going to try, right? If you expect that you're going to fail. So it's only if you see a way that you could cheat somebody that you will then try to cheat them, if you have the incentive to do it and you feel like you can rationalize it. Now let's think about that. Let me get your input on this. Why might a person rationalize committing fraud? How might they tell themselves, it's okay that I did this illegal, immoral thing? It's okay because what? What rationalization might they have?
Christopher? They think the company is immoral.
Okay, if you think, hey, my company's immoral, so it's okay for me to be immoral. I'm like Robin Hood. I'm stealing from bad people, you know, to help others. That would be a rationalization. It's not, you know, I don't think it's a very good rationalization, right? But no rationalization of fraud is good. So that's one. My company is immoral, so I can be immoral. Why else might somebody rationalize committing fraud? What might be going through their head that tells them it's okay to do this thing? Okay. So you might think my financial situation is so bad, I have no choice. I have to do this thing, even though I know it's wrong. I have to do it because I just have to, right? If I don't do it, they're going to come break my legs, or you know, my family's not going to eat, or my wife is going to leave me, right? And so I have to do it. Maybe somebody thinks I deserve it. Or maybe somebody thinks the whole world is corrupt and the only way to get ahead is to cheat others. So these are just some of the rationalizations. You know, they're not rational rationalizations, but this is what might go on in somebody's head that tells them it's okay for me to do this. Because if they don't have any rationalization, if did you ever see Pinocchio and how Jiminy Cricket was his conscience, right? If they don't have a little Jiminy Cricket there in their mind telling them this is wrong, you can't do it. They don't have that, they'll do it, right? But if that voice in their head is louder, if their moral compass is stronger than that rationalization, that they won't commit fraud. Right? So it's that kind of tension between what you know is right and what you believe you should do. All right. So those are the three elements that have to exist for fraud to occur. Anybody have examples without maybe naming names, but what are some examples of some frauds out there that you might have heard about? Like, I said don't name. Certain former political figures might have been sentenced and accused of fraud in the past. That is true, and in the future they might get sentenced. Who else? What else? What else did I hear? Think about Jeffrey Epstein. He was accused of sex trafficking of minors, possible espionage, representing himself as a hedge fund manager when he really didn't have that experience. He was maybe laundering money. You know, there's a lot of mystery about what exactly went on there. That's a lot of fraud. Well, okay, Enron, we talked about Enron a little bit. You know, they were lying to their investors about how profitable they were. Bernie Madoff. Okay, I am naming names, but these are people that have been adjudicated in a court of having committed a crime. Bernie Madoff, $65 billion fraud he committed, tricking his investors. So there are many examples out there. And I don't know why it's so fascinating to me. I think it's because a lot of times, as I mentioned, people who do this do have what's called a personality disorder. and I'm no expert, but from what I understand, it doesn't mean there's something wrong with their brain. It's not that they have a mental health issue. It's that their belief system, somehow, a lot of times at childhood, their belief system got messed up. And they somehow came to believe that they were better than everybody else. And that they could cheat others and it was somehow okay. So it fascinates me that people would even do these things. But that is the fraud triangle. Anyone have questions or comments? Right. So as a company, one thing you can do is have somebody within the organization that audits the books, that looks through to make sure the numbers are entered properly, nothing's missing, nobody's stealing from the company. So you might have an internal auditor. They can then, if there is a problem, they could bring it to management and say, hey, looks like there's a mistake over here in the books. Let's see, was this just an innocent mistake or is somebody trying to trick the company? But if you're a publicly traded corporation, you're required to also have an external auditor, somebody outside the company, typically a certified public accountant, that comes in and they audit your books. And then they sign off on your annual financial statements to say, we have audited these statements and we confirm that they are accurate and thorough. And the executives have to sign off on those financial statements too. Okay, so the internal auditor plays an important role, but so does the external auditor. And that ties into internal controls. So when you have a small organization, let's say it's just you and maybe you hire a couple employees, it's pretty easy for you to know what's going on and maintain control. The bigger your organization gets, the harder it is to keep everything in control. I'll give you an example of a friend of mine down in Southern California who bought a business. He bought a furniture business that sold furniture to other businesses. And when he bought the company, he looked at the financial statements and the company showed it had been very profitable. And something just didn't seem to add up to him, but he couldn't find any mistakes. So he went ahead and he bought the business. Well, after he bought it, he came to learn that the owner, the previous owner of the business would pay themselves, and that showed up in the records that they weren't paying themselves, but they never cashed the checks. So it showed up that these payments were made, but the company had more cash than it was supposed to because they never cashed the checks that they paid to themselves. And so that meant that my friend, as the new owner, realized if he was going to pay himself, the company wouldn't have enough cash. Because if he's cashing the checks, then the cash balance is going to go down. So he realized the company wasn't as profitable. I think if he had done a better job comparing the income statement and the statement of cash flows, he could have caught what was going on, that there was something funky, but he didn't until it was too late. And I mentioned to him, why don't you sue the previous owner? He's like, oh, the guy's like 80 years old. And, it's too much of a headache. I'm just gonna take loss. Another thing that happened to him, same company, his main employee had been with the previous owner, stayed with the company, and was doing a great job for years after my friend bought the company. In fact, if I remember correctly, that was his only employee. So it was basically him and this other guy. Well, my friend, after years of running his company, decides to take a vacation. with the family, they go to Hawaii or someplace. While he's on vacation, that employee that he had trusted, that had been doing such a good job, embezzled, stole money from the company. So when my friend came back from vacation, the money was gone. How could this happen? Why would this person do it? Well, it turned out the employee had a meth addiction that had gone undetected by my friend, and he didn't realize it. All this time, the guy was an addict. As soon as he had a chance, he stole the money. So, even in a small company, you need some internal control systems to prevent these sort of things from happening. So how do you do that? There's an organization that serves accounting companies specifically. This is an organization made up of accountants committed to helping the accounting industry. It's called the Committee of Sponsoring Organizations. Okay. I don't know a whole lot about it, but they came up with these 5 aspects of internal controls. If you want to make sure you have a company that's in control, where there's not theft and fraud going on, you have to control the environment. You have to assess what risks there are. Like my friend maybe should have realized there was the risk that this employee he trusted could steal all this money, even though he didn't suspect it would happen. He should have realized there was a risk there. You have to control the operational activities happening, like, for example, the inventory, the processing of payments, and so forth. You need to monitor your control processes, make sure your control processes are working, and the communication of information. So these would be the 5 aspects of an effective internal control system. Okay. And this ties in quite a bit to accounting information systems, right? Because a lot of this could be computerized and automated. All right, any questions or comments?
Does your friend still have a business?
As far as I know, he does, yeah.
Okay.
Yeah.
Profitable now, or no?
No, yeah, I think he's doing okay. Unfortunately, he and his wife have divorced. His wife was the main moneymaker in the family. She was a dentist, and so he doesn't have her financial support anymore. But as far as I know, he's still paying his own bills, so.
And then the other percentage of the job, is he with
Don't know if the employee went to jail, or I'm not sure what the outcome is of that. Can you imagine that? I mean, somebody,
Yeah.
your only employee who you've trusted all these years, man, must have been really tough to go through that. Almost makes you not want to go on vacation, right? If you're a business owner. Okay, any other questions or comments? All right, so your internal control system, you need to make sure assets are properly used. So if an employee is given the ability to write a check or use company money, we want to make sure they can only use it for appropriate purposes, right? If there's some material that the company uses to make products, you want to make sure employees are not taking that material home or not taking finished products, selling them out the back door. Here's another story. When I worked at AT&T Wireless, there was a guy in my department. Our job was to call customers who had canceled and try to get them to change their mind. That's what we did. And there was one guy in my department who was doing better than anybody else. I was kind of jealous, I'll be honest. Like, how's he doing such a great job? And at one point I heard him like using some very inappropriate language over the phone talking to a customer. And I thought, oh, our supervisor needs to know about this. So I went to speak with the supervisor and I said, hey, actually, I think his name was Julian. It wasn't you. It wasn't you. Where's the other deal? It wasn't you. different one. No, his name was Julius. Julius. So I sat down with Julius and I said, hey, I think you ought to know this employee is saying these inappropriate things to customers. And he's like, don't worry about it. I've already fired him. I said, oh, what happened? And he said, this employee, we had the ability, in order to keep a customer from canceling, we had the ability to get them a new phone. And this is back in the 90s when phones were, well, they're expensive now, but they were expensive back then too. So what he was doing was he would requisition the phone for a customer, but instead of giving it to them to keep them from canceling, he was selling it. He was selling these phones. Not only that, he had been caught in our company's cafeteria bringing a customer in, and there wasn't supposed to be a customer on the premises, and selling him the phone right there in the cafeteria. So what I overheard, the inappropriate language, was nothing compared to the fraud he was doing. So anyways, you want to make sure company assets are being used properly. You want to make sure your accounting system is functioning so that you know where the money's going. There have been cases, even here locally, where somebody cheats their employer, in some cases out of millions of dollars, without the employer knowing about it. In some cases, they set up fake accounts, so it looks like these are legit transactions, but these accounts are actually going into their bank account. Or in other cases, they might do something where, like there was a computer programmer one time who, when every financial transaction would get, if the financial transaction was in a fraction of a cent, like if you're charging a customer for electricity usage or whatever your product or service is, sometimes you end up with these fractions of a cent based on the price. And he would have it so it would always round up, and that rounded up penny would go into his own bank account. And that seems like it's not even worth the effort, but if that's happening millions of times every month, it starts to add up, right? So you want to make sure your accounting system is not somehow being used to filter money out. You want to make sure things are running efficiently, right? You don't want to put so many controls in place that nobody can get any work done. But it's a balance. How do you make it safe and efficient? Valuable assets are supposed to be kept secure. For example, over in the music building here, in one of the classrooms, there's a cage for the grand piano, so that they can roll the grand piano into the cage, lock it up, and nobody can steal it. Now, how someone's going to steal a grand piano, I don't really know, but that's designed to provide further protection. Make sure company policies are being followed. If you're in a corporation where people just feel like it's okay to break the policies, it happens all the time, well, it's more likely that fraud could occur than if everybody is very strict about following the policies, right? That's up to each organization to think about what policies do we need and how strictly do we enforce them. Okay, so by taking some of these steps and having an effective internal control system, you reduce the chance of the company being defrauded or any stakeholders being defrauded by somebody in the company. All right, any questions or comments? Okay. Oh, here's an example. So this was in Oklahoma. There was a small bank. I don't know how small it was. Security National Bank. Maybe it wasn't that small. I don't know. But this person was a senior vice president at this bank in Oklahoma. In his position, he had the ability to write loans and then deliver the money. So that one person, he could say, oh, I'm going to go ahead and authorize this loan for whoever, Sally over here. And then I'm going to give the money to Sally, but then he'd actually put it in his own account. And it turns out Sally didn't even know an account had been opened up in her name. This guy was opening up accounts in random people's names because he had access to their social security numbers and things like that. They knew nothing about it, and he was keeping the money until he got caught. And he was a senior vice president. He stole 6.2 million. When he was caught, he was sentenced to 13 years on 33 felony counts. Now, he should never have been able to both approve the loan and manage the payment of the loan. Those duties should have been kept separate, so they had to be done by separate people. So unless you have those two people colluding together, they couldn't commit the fraud, right? Okay, here's an example of a process that's effective at controlling both the inventory and the payment. So imagine a company that sells jeans to the public. Okay, so you go in to the store, pick out the jeans, take them up to the cash register, right? When it gets scanned at the cash register knows the sale was just made. It can automatically update inventory. Now we know we have one less pair of jeans. It can automatically notify the supplier in case we want them to automatically send us a replacement pair. It automatically specifies how much the customer is supposed to pay. And then when the customer pays, it processes the transaction and shows that the payment was received. So it would be very hard for an employee to cheat in that process. There was one time, I remember, this again was in Orange County. I went to a Taco Bell that I went to with my kids all the time because it was right on the corner. And they loved eating burritos back then. And I know Taco Bell's not the best, but kids love it. When you have kids, it's like, if they'll eat, great. Whatever they'll eat, you eat it. So there was one time when I placed an order and I noticed that the guy forgot to ring up the drink. So I reminded him, and he'd already processed the transaction. So he said, "Oh, okay, well, just give me $2." And then I gave him the money, and he gave me change, but I noticed he didn't ring it up in the cash register. That's a little suspicious. I think he's pocketing those couple dollars. So I sent a message to the manager of that store, and I never saw that guy there again. So I think I got him fired, but hey, serves him right? If he was pocketing the money. Another benefit of this process with the jeans is the marketing department then knows how many pairs of jeans, which types of jeans got sold, what's not getting sold. And so they can make better decisions about what to sell in the store. So it's a pretty good process. It would be hard for somebody, not impossible, but hard for somebody to do like the same thing that happened to Taco Bell. Somebody walked up and said, "I'd like to buy this pair of jeans." And somebody said, the cashier said, "Okay, that'll be $40." And customer's like, "I want to use a credit card to pay." Person, if they pull out their phone and say, "Okay, I can process this on my own personal cell phone," the customer would be very suspicious of that, right? So they kind of have to do it through the system, making it hard to cheat. Okay, comments, questions? Maybe you've seen internal control systems in your workplace. Maybe you've seen examples of bad internal controls. Anybody have any thoughts? No? Okay. So then we get to the Sarbanes-Oxley Act. That was passed back in 2002. Enron and WorldCom were the two corporate fraud scandals that were most notorious at the time. There were others as well, but those had a big role in telling Congress, look, we have to do something because there's too much fraud out there. So Congress got together, two senators, Senator Sarbanes and Senator Oxley. They put together this law that basically says that corporations have to have internal control systems, especially if they're publicly traded. The CFO and CEO have to sign off on the financial statements. The financial statements have to be audited by an external auditor. Whistleblowers have to be protected. If they are blowing the whistle to say there's fraud at my corporation, they have to be protected. And what else? As it says here, who's doing the audit rotates, so it's not always the same person. Oh yeah, and then that was the other thing. It used to be, before the Sarbanes-Oxley Act, accounting companies could consult and audit. And that's what happened at Enron. Their accounting company was a company called Arthur Andersen, and they were one of the big 5 accounting firms at the time. And Arthur Andersen allegedly was telling Enron how to cook the books, how to cheat. And they were also auditing books to say, Enron's not cheating. Now, is that a conflict? Yes, it is. So this law made that illegal. So you could, if you're an accounting firm, you could consult or you could audit, but you can't do both, especially not for the same client. So that was also part of Sarbanes-Oxley. If you want for short, you could just refer to it as SOX. So any comments or questions? Oh, this is from Enron's stock price. So at one point, their stock was worth about $90 a share, August 2000. Within, what would that be? 2002, about 18 months. Within about 18 months, is that right? I can't. I know it's an accounting class, but let me think, I can't count. So January of 2001 would be 6 months. Yeah, 18 months, right? Within about 18 months, their stock price went from about $90 a share to about 0. Because at some point, one of their accountants blew the whistle and said to the authorities, some government agency, I think there's fraud going on at my corporation. And they looked into it, did an investigation. When the executives realized that the truth was going to come out, that the company was not as profitable as it had been pretending to be. Because what Enron was doing was they set up all these shell companies outside of the US to try to make it look like Enron was selling more to those companies when really it was selling nothing to them, making Enron look more profitable. So that was against, well, it wasn't clear that it was a violation of GAAP, but it was certainly not something that GAAP said you could do. And when it went to a court, the judge said, oh, that's definitely illegal. Even though it's not specifically in GAAP, what you're doing is illegal. So when it became clear to the executives that that information was going to come out, well, then they knew that their stock price would crash. Because if you're an investor in a company and you find out that company really wasn't as profitable as it said, you're probably going to sell your stock. And everybody else is selling their stock. And nobody's buying the stock, so the price crashes. So the executives started to sell their own shares when they knew what was coming. By the time it went public and the public knew what was going on, the executives put a freeze so that the employees who had Enron stock in their retirement plans were not allowed to sell it. Which meant that those employees ended up with stock worth nothing because they couldn't sell it. And two of those executives were, at least two were sentenced to jail, the CEO and the CFO. Both were found to be guilty. The CFO, Jeffrey Skilling, he did jail time. The CEO, conveniently for him, died before serving jail time. So he actually never went to jail, but he was also convicted. So that was a big motivation for Congress to change the law, making it harder for this sort of fraud to happen. Now, does that mean we don't have fraud anymore? No. There's still fraud. Okay, so some examples of how to create an effective internal control system. Make it clear who's responsible for what. Like thinking back to that bank situation, you had this senior vice president who had the authorization to write loans and fund the loans, right? Those duties should have been separated. He never should have been able to have his hands on the money for the loans he approved, right? Those responsibilities should have been given to somebody else so that he wouldn't have the temptation of doing that. We want to make sure everything's documented properly. There have been so many cases like our former Secretary of the Treasury was Steve Mnuchin. And before he was in that position, he ran a mortgage company that wrote all these mortgage loans, and the people that were supposed to sign off on these loans didn't actually examine them. They just sort of stamped their approval on them. That never should have been allowed to happen, right? You shouldn't be able to just rubber stamp. I remember, okay, way back, I worked at Nintendo, and one of my jobs there was to send out letters to customers in certain situations. And we actually would stamp those letters with the name of an employee, but that employee didn't write the letter. Now, I didn't feel great about that because I knew if they called in and they wanted to talk to that employee, we'd be like, oh, well, they're not available, but I could help you. So I never felt comfortable with that. Now, we weren't committing fraud in that case, but I just didn't think it was good from a customer service perspective. But if you've got somebody who has, because of their license or because of their role in the company, they're authorized to sign something and somebody else is signing it on their behalf and doesn't have the authority, you're deceiving whoever's the recipient of that information. So you want to make sure your documentation is filled out accurately, thoroughly, properly signed by whoever has the authority to sign it. The company should make sure it has insurance. Let's say the company is the victim of cyber crime or fraud, whatever might happen. You should have insurance to help compensate your employees or customers or whoever got impacted. There are insurance programs out there to help with that. And you can also use technology to try to automate your processes and prevent fraud. Okay, so those are some of the things that go into an internal control system. Any questions, any comments? All right, most companies, especially medium or large companies, keep a list of vendors that are authorized. These are the companies that they can buy from. Why would that be important? If you were, let's say you're in charge of accounts payable, right? So it's your job to make sure that you pay your suppliers, right? We know if you pay them early, you might get a discount. If you don't pay them, they might get very upset and sue you or your company. And so your role is to make sure your accountants are getting paid. And not your suppliers are getting paid. Why would it benefit you to have a list of who those suppliers are?
Easy to fake invoice.
In case you get a fake invoice. What if one of your employees generates an invoice for ABC company that's actually something they established, and they're the ones who own the bank account that ABC company deposits money into, and they present an invoice and a purchase order that makes it all look legit. And you're signing off on this and you're saying, wait a minute, I've never heard of ABC company. Who is that? And they say, oh, it's one of our suppliers. Well, they're not on the supplier list. Where did they come from? Oh, I don't know. Right? That's how you could catch that potential fraud. See, I'm telling you how to commit fraud here. But don't do it. All right. Oh, and what about us personally, right? We can all be the victims of fraud, right? So what can we do to prevent that? Here's an example of the Equifax breach, where Equifax, okay, there are 3 companies that are credit rating agencies for consumers. So your credit score comes from either Equifax, Experian, or TransUnion. All 3 of them generate a credit score for you. And that means they know your social security number, every place you've ever worked, every place you've ever lived, probably your driver's license number. They know more about you than, in some cases, than you might know. Like, I've looked at my credit report at times and said, oh, I forgot I used to live there. Oh, I forgot I used to work at that company. They've got it all. Every account you've ever opened, every time, if you've ever been late on a bill, how late you were, how much the amount was, they know all that. And you would think having that much information, confidential information, they would protect it. Well, what happened at Equifax is there was one employee in their IT department that failed to update one piece of software. And because they didn't update that software, the hackers got in, stole more than 100 million Americans' data. And Equifax then had to notify all this 100+ million people, I think it was around 150 million, notify them, hey, we were hacked. I know you trust us with your data, but they got your data, or they might have gotten your data. And we have to give you now credit monitoring services and identity theft restoration services for a couple years, which was paid for by their insurance, or at least partially paid for. What a mess. One employee's mistake. And it wasn't fraudulent in this case, right? Just a mistake. So how do we protect our data, or ourselves, or our assets? Okay, what are some things you can do to protect your data and your assets? Passwords, locking things up, being careful about who you give information to, especially with these deep fake technologies now, where somebody can take the sound of somebody's voice and then make it seem like it's actually them. My father and my stepfather have both gotten calls from somebody claiming to be a grandchild. Fortunately, they did not fall for it. But can you imagine if that caller used the voice of one of my kids? It would be very convincing, right? When you hear the voice of your grandchild saying, hey, can you send me $500? I need it right now. I know somebody, a young person. He was early 20s at the time. Got a call saying that his social security number had been compromised. Now, the person calling clearly was calling from another country and had an accent. So you could hear that it was an international call, and the person had an accent. And so he was a little suspicious. But this person was saying, I'm calling from, I think it was the IRS, and your social security number has been compromised. We need to get it fixed. So here's what you need to do. You need to go to this machine at this one location, put in your ID and bank information, and do this transaction, and then we'll know it's you. And again, the person was suspicious. Now, the caller said, this is all legit. I'm working together with the local police department. They are going to be calling you to authenticate what I'm saying. So the victim gets a call showing it's coming from their local police department. And now it sounds like it is a local call. The person sounds like a police officer saying, oh yeah, I'm so-and-so from such and such police department. Yep, this is all legit. We need you to go to that place, put in that money, make this Bitcoin transaction. And the person felt intimidated. They were at work, they were stressed out, and here's the police telling them to do this thing. It didn't make any sense, but they trusted the police officer when it really wasn't a police officer. And it was after the person had done this transaction that cost them $1,000, they called me and said, I just did this thing. You think it was a scam? I said it was a scam.
You're asking that.
Exactly. If you have to ask yourself that question, it was probably a scam. And if you have to ask yourself the question, is what I'm doing unethical? It's probably unethical, right? But unfortunately, these scammers can be very, very tricky. In my family, just recently, we agreed on a password for the whole family, so that if we ever get a suspicious call from somebody pretending to be a relative, we can say, what's the password? And if they don't know it, sorry, I don't believe you're who you say you are. And it's sad that we have to do that. But this is the world we live in of fake identities, right? Okay, questions, comments? Okay. Let's see. Yes, petty cash. Okay, so petty cash is one aspect of an internal control system. What it is a way to have some cash available at the office so that if small purchases have to be made, you don't have to go through the process of having a check cut. And it doesn't seem that bad to have your accounting department write a check, but I've seen studies that show that, well, I've heard reports that the cost of writing a check is at least $12. By the time somebody puts in the request for the check, somebody has to approve that request, has to go over to the accounts payable department, they have to enter it in the computer, they have to process it, send the check to where it goes. You count the labor that's involved, we're talking $12, maybe more. So if you're trying to purchase something small, why go through that whole process of having a check written, right? Doesn't make sense. So instead, a lot of companies will have a petty cash drawer, maybe a petty cash safe, and they keep some cash there. And somebody's in charge of that cash. And what they'll do is if a small purchase has to be made, like maybe you need to send somebody down to buy some toner for the printer. So you give them $100 to go make that purchase. The person that's in charge will take that out of the petty cash drawer. The employee goes and makes the purchase, gets the receipt, because you need to have proof of what was purchased, not only for internal purposes, but the IRS wants to see that when they audit the company's books. Bring back the receipt and the change, and then that all gets documented in the accounting system. So it's more efficient than having to have a check written and just easier. Okay, so that's what petty cash is all about. Now, the way we do the accounting for petty cash is different from other accounts that we've seen before, so it takes a little bit of getting used to. It's called an impressed account. It doesn't mean that you're impressed with it. It's spelled differently, impressed account. What it means is that once you establish it in your accounting records, like let's say you put $200 into your petty cash fund, that $200 never changes. The amount of money that's actually in the petty cash drawer can change. But in the accounting records, it stays at $200. Unless you decide you want to increase it, or unless you decide you want to decrease it, it just stays at that amount. So we have to have a way of accounting for anytime we use that petty cash fund and the receipts, right? How do we account for that without changing the petty cash amount? So that's what I will show you. This is an example of a petty cash receipt. This would be within the company. It's not the receipt that came from the store. This is a receipt where it says on such and such a date, the person in charge of petty cash approved, there'd be a receipt number. Do I identify this particular receipt? Who it was that the money was given to, what they bought, and what was the amount. So that now as a company, we have a record and we can turn that over to the accounting department and they can update the accounting of what was spent, what was purchased, and make sure that the same amount of money gets put back into the petty cash fund. And that's why the petty cash fund always stays at the same amount, because at the end of the period, you just put more cash in there. So here's an example. This would be to establish a petty cash fund. From what you know about a petty cash fund, what type of account do you think it is? Is it an asset, a liability, or equity?
Is it an asset?
It's an asset. Cash is an asset, right? If it's in our bank account, we record it in the cash account. But if we take it out of the bank account, cash goes down, and instead we put it in a safe and call it petty cash. We still have that cash. It's just now not in our bank account. It's in our petty cash account. Okay? So we're just moving that asset from the bank account into the safe or the locked drawer or wherever we keep the petty cash. Okay. Any questions so far? All right, so let's say we've got these 3 transactions. During the month, we buy some postage stamps, some milk, and some window cleaner. Okay? And these were all paid for out of the petty cash funds. This is what the journal entry would look like at the end of the month. We would record those 3 expenses, right? There was the postage, there was the milk. I guess milk is part of our inventory. And what was the other one? Oh, window cleaner. You don't want to have a window cleaner account if it's something you don't purchase all the time, right? So sometimes you'll have just a miscellaneous expense account for those small sort of things that you don't really need to track, right? You want to track that there was a transaction, but who cares that it was window cleaner because it was only $5. So these were the 3 purchases that were made. They're all, this one's an expense. The milk, if it's something that we're going to resell, or maybe we're a coffee shop, and so it's part of our cost of goods sold because we use it, for making lattes and things like that, well, then it's inventory. And the window cleaner is an expense. So all of those get debited because Inventory is asset, and expenses are also part of deal, so they go up on the debit side. But then notice the other part of it. We credit cash for the total of those costs. Because what we're going to do at the end of the month is we're going to take $45 out of the bank account and put it into the petty cash drawer. So now our petty cash is back up to the $200 or whatever it was before. That's all we have to do. Notice in this transaction, there is no petty cash account because it never changes. We just replenish it out of our bank account. And that's an impressed account. Any questions?
I have a question.
Yes.
When you look at your petty cash
Mhm.
on the chart of accounts, will these expenses show up on this too?
Will,
Or this is,
will what show up there?
these expenses, like would you have,
Yeah, each of these would be on the chart of accounts. So you'd have, if this company has a lot of postage expenses, it probably will have a postage expense account, obviously an inventory account, miscellaneous expense account. Yep. You see where we're at in the chapter. Oh, we're more than halfway through, which is good. Let's cover a couple more slides and then we will break for that discussion activity. Want to make sure you have a good understanding of petty cash before we do that. Now, sometimes you might have a case where an employee loses a receipt or forgets to bring back a receipt. You might have a case where somebody didn't get enough change when they made the purchase, or maybe they got too much change. Or who knows what else might happen. But it could be that at the end of the period, when you add up all the receipts for things that were purchased with petty cash, the total is different from the amount of petty cash that got used. In that case, you're either over or you're short. You either have too much cash in the petty cash drawer, or what's more common, you're missing some money, right? So there's an account that we use for that. Cash over and short would be the account you use in both cases. If you're short, that means you need to take more money out of the bank account, so cash is going to get a credit, and you would debit cash over and short. But if you have extra money, it will be the opposite of this, because then you can put that extra money back into your bank account. So in that case, you would debit cash and you would credit cash over and short. Okay? So that's how we reconcile if there is a shortage or overage at the end of the period. Any question on that? Okay, let's say you decide to increase the petty cash amount. You decide that, hey, the amount that we had in there before wasn't enough. We feel like we need a little bit more in the petty cash drawer. The way you journalize that is exactly like when you created the petty cash account in the first place. You would debit petty cash and you would credit cash. Because again, you're taking money out of the bank account and putting it in the petty cash drawer. So if you wanted to decrease your petty cash amount, again, let's say it was 200 and you want to bring it down to 150. What would that journal entry look like? This is if we want to increase it, right? So if we want to decrease petty cash, what would we do? Exactly. The opposite. Thank you, Yannette. We would, in that case, debit cash. Because cash in our bank account's going up. And credit petty cash because it's going down. Okay? So that's about all you need to know about petty cash. We'll get to the exercise later, so I think we'll just stop there for now. And we will do the discussion activity. Are there any questions? other than what is the discussion activity?